to have this Thursday, we're going to have Richard Barker start us off with the first 45 minutes in his presentation. Then we'll move on to Henry's for the second time slot. So Richard, go ahead and share your screen whenever you're ready. And I'm delighted to introduce him, presenting his paper, Seeing Double, Financial Accounting and Reporting from the Perspectives of Both Financial Materiality and Environmental Materiality. So I'll give you a 5-minute warning if that's okay. And then
Okay.
I'll also,
So how long do you want me to talk for? Because we've got, and do you want me to take questions during or?
Well, that's up to you. I think typically you could take questions during the presentation, if that's all right with you.
That's absolutely fine. Yeah. And there's
All
45
right.
minutes in total, right?
Yes.
And I'll send you these slides. So there's more information on the slides than I won't cover every word, but I'll talk through the structure of this and so on. I'm very happy to answer any questions as we go along. This is the theme here is sustainability reporting, a very topical issue of sustainability reporting, and in particular the issue of materiality, the distinction between single and double materiality. So single materiality reporting material information for investors, double materiality reporting both to investors and more broadly to society. And this is a normative paper. This is not an empirical paper. It's addressing the question of, well, how do you reconcile in principle these two perspectives? Just to illustrate from a real example here. So here's a major oil and gas company. That's its mission statement. It's very clearly focused on, it's a traditional oil and gas company, right? This is what we do is we burn hydrocarbon, right? Here's another mission statement, which looks a little bit different. It's, okay, we're a hydrocarbon business, but we operate responsibly, right? So this is a CSR type statement. It's CSR is something we're mindful of, but our core business is our core business. So, get over it. Right? Here's another version, which is same industry, same business, and this sounds terribly green, right? Our purpose is to reimagine energy, and we want net zero. So here you have a totally bizarre, on the face of it, mission statement, which is our purpose as a business is to stop being who we are, right? This is a 99% hydrocarbon business saying that's not what we want to be. Now, on the face of it, those are three very different statements, or not. Actually, you can reconcile all three of them by saying they are different ways of interpreting how to create value for shareholders. So Aramco is saying we can carry on, we're fine. Exxon is saying as long as we're responsible, we're fine. BP is saying we're not fine. Our business is changing, our world is changing. If we don't figure out how to make a profit from not selling hydrocarbon, then we're not going to be a business anymore. And therefore, this is not a green statement, it's an investor-oriented statement. So this is a world that is quite rapidly changing that requires a degree of careful interpretation, I think. The SEC, as you will know, is wading into this space. It's saying, look, companies are going to have to report climate-related risks because this is financially material. Unambiguously, the statement is single materiality. Whether they will get this through is another matter, but that's the statement. International financial reporting standards are evolving to include sustainability reporting standards, right? So there's now going to be a separate board sitting alongside the IASB, which will set climate standards. It already has an exposure draft in issue. Again, investor oriented. The reporting literature, the accounting literature here, there's two literatures. There's financial accounting, there's sustainability reporting. So everyone on this call will be very familiar with the financial accounting literature. The sustainability reporting literature it's been around for a long time, 30 years or more. It's been relatively a minority sport in that time, and addressing issues that are largely separate from the mainstream financial accounting literature. Typically, sustainability reporting literature has focused on externalities, as it were, on things that are different from financial accounting, on social and environmental impact as a separate issue from financial performance for investors. There's a nice review paper by Jeffrey Unerman and others, which this is an accounting and business research, which summarizes this literature on accounting for externalities and basically describes this silo, right? These two separate worlds of financial accounting and sustainability reporting. Meanwhile, the sustainability reporting literature is dominated by empirical positive studies. So things like explaining why companies make the voluntary sustainability reporting disclosures that they choose to make, given that the environment is voluntary. There's very little normative work. There's very little which asks the question which this paper asks, which is, well, what should sustainability reporting look like, and how should that be aligned with financial reporting? So if you're going to think about these two worlds together, think about the IFRS announcement. They're thinking about them together, right? You've got an accounting board and a sustainability board, and they're part of the same organization. How should those, in principle, work together, and how does that address single materiality and double materiality? This is not explicitly in the paper, but I think it's helpful in framing this. There's one of Keynes's many well-known quotes. This is the beginning of the general theory. Practical people who believe themselves to be quite exempt from intellectual influence are usually the slaves of some defunct economist. In other words, we grow up thinking in a certain way, and you know, as sort of empirical financial accounting researchers, the way we think is strongly framed by financial economics, and that can be quite dangerous. Especially in the context of externalities and the context of valuation. I'm going to come back to both of those things later, but I think in many ways our kind of instinctive reasoning constrains thinking through what the appropriate solution is in this space. Okay, so briefly, the paper is normative, and the question is, how can you develop a report in a financial accounting sense, which provides both financially material information to shareholders and societally material information to broader stakeholders. The way we do this is we say, let's not try and fix financial reporting. Take that as given, right? That's the starting point. So whether it's IFRS or whether it's US GAAP, it really doesn't matter. Given that we do financial reporting, given that we do it in the way that we do it, assuming for the sake of the analysis that it's well developed for purpose. I notice actually I'll come back to that later. So assuming it's evolved over time to be suitable for purpose, as it were, given that's what we've got, the institutions are embedded around it, how do you expand financial accounting to incorporate sustainability reporting? So rather than saying there's financial accounting in one place and sustainability reports in another place, how do you bring them together? The proposal, to sort of cut to the chase, is one of monetizing environmental degradation at current replacement cost. Notice there is monetizing, right? So in order to incorporate in financial statements, but not monetizing at a valuation, but at a replacement cost. To go back to the point I just made, following the Keynes quote, I'll explain what the thinking is behind that in the presentation. Final point: the sustainability reporting literature is very critical of investor-oriented sustainability reporting. In other words, very critical of what the SEC is trying to do, what the ISSB is trying to do, what TCFD is doing, what integrated reporting is doing, and so on, and also SASB, because they are perceived to be disingenuously capturing the notion of sustainability, as it were, taking this notion of sustainability to mean financial sustainability. So instead of sustainability meaning what is the impact that the business has on society and the environment, in other words, externalities, the focus becomes what is the impact of the environment and society on shareholder returns. So sustainability means the sustainability of financial performance. It doesn't mean sustainability in sustainable development goals sense, and therefore that is a dangerous and misleading position. Barrett, go ahead.
Hi, Richard. Yeah, just a question on your third bullet point there, a question of clarification. Say proposed monetizing environmental degradation at current replacement costs. It's interesting because I've thought about that type of thing before.
Okay.
But you're saying from an accounting perspective, even in the absence of actual regulatory or legal
Right.
costs to remediate?
So hopefully I'll answer your question as I get to the slide talking about that. If I don't, can you come back then and ask the question again?
Sure.
So this slide is just an overview of what I'm about to cover. Essentially, is the idea. Stephen, go ahead. Hi.
I think this is a key point, the distinction between financial sustainability and more sustainability for society. And there's difficulties here. If I'm on a board of directors, I have fiduciary duty to the shareholders, okay? That's the law.
Yes.
And I can't pursue anything else.
Yes.
So I think that's got to be dealt with either through other institutions, sustainability corporation, whatever. But as a director, I cannot do what
Yep.
the sustainability people want. Mm-hmm.
Yep. I think that's right, and I think so. And so you have to have a system of reporting which respects that distinction. And again, I hope what I'll do is set out how that can be thought through, because I think that those kinds of questions are conflated in the debate around all of this.
Mm-hmm.
And part of the purpose of the paper is to unpack that, and so it's no longer conflated. Okay, so if you think about a very brief statement about financial accounting, and pretty obvious statements for this audience, but nevertheless, it's, the structure of the paper is grounding reporting in financial accounting and then extending it to include sustainability reporting, whatever that means. So, so IFRS is structured in terms of financial materiality. This is consistent with the point Stephen just made. It's reasonable to assume economic rationality. You've got a structure of double entry or very straightforward stuff. Whether US GAAP or IFRS, the way financial accounting works is this two-stage filtration process of recognition criteria and measurement attribute. Financial reporting is broader than financial accounting. And so if you think about the conceptual framework of either IFRS or FASB, the sort of the overall mission is expressed in terms of providing relevant information to investors in order to make investment decisions. And the framework then jumps to say, and this is how you do financial statements. But information that is relevant to investors is not just information that's in financial statements. So financially material information, whereas financial reporting is broader than financial accounting. Again, I'll come back to that. It's an important point. Natural capital, the resources of nature, as it were, are not defined in financial statements. I refer here to missing information in financial accounting. What I mean by that is this distinction between reporting and accounting. So sustainability related financial disclosure from a financially material investor oriented perspective is information which is relevant to investors in the determination of enterprise value, even though it's not in the financial statements. So for example, Shell lost a legal case in the Netherlands last year, where the courts determined that it was not acting, a case brought by Greenpeace and others. The court determined that Shell was not acting unlawfully, but that if it continued to operate in the way it is currently operating, it would be acting unlawfully in the future. In other words, it's not. In other words, it has a legal commitment to transition to meet climate targets. So if you're an investor, the the fact that Shell's business is heavily associated with costly environmental externalities is largely not relevant to the measurement of financial performance. But it is relevant to the determination of enterprise value because it's relevant to the ability of Shell to be able to make money in the future. A recent development in this case is that Shell is being sued to Stephen's point, Shell is currently being sued for a failure in its fiduciary duty to shareholders because it is inadequately prepared for climate transition. And this puts shareholders' funds at risk. So information, to the earlier point of externalities, information about externalities is financially material if you're Shell. It's not in the financial accounts, but it's financially material because if you're an investor, you need to know the scale of transition that Shell is faced with. And if you don't understand the transition that it faces, you can't determine the enterprise value because you can't determine its capacity to generate cash flow in the future. So sustainability, so the meaning of sustainability related financial disclosure is it's financially material. It's not in the financial statements. It is a part of financial reporting. So in a sense, it's the remit of the International Sustainability Standards Board. Now, the way to, if you think about financial statements, and this is, I'm picking up, Stephen, on your paper in Abacus on the income statement, on the work we've done in the same space here as well. The income statement is particularly important to think about here, rather than the balance sheet. So the first point is we know, if you like, that the businesses will have to transition to meet Paris climate targets. And if they don't, we're all in trouble, right? So there is a consensus, there's increasing legislation, there are corporate commitments, so there is a certain predictability about the future. Now, the future normally is not predictable, but there is something in this, in the space of sustainability, in particular relating to climate, that actually provides a link between the past and the future, as it were. We know that historical financial statements are relevant to the future insofar as the future looks like the past. So the process of matching in financial statements is useful as a guide to prospective decision making, as long as you have stationarity, essentially. If you don't, and the nature of climate change is that you don't, then the usefulness of historical financial information is reduced in comparison with other information about value drivers that help you to understand future cash flows. So to the extent, if you take BP, the example I showed earlier, to the extent that BP is saying, we are going to be a dramatically different business, BP's historical profits are largely not relevant to the consideration of what its future enterprise value will be. I exaggerate slightly, but you get the idea. Moreover, it's obviously increasingly the case that environmental issues and capacity to generate profit are not unrelated from one another. That both in terms of physical risk and in terms of transition risk, corporations are increasingly exposed to impacts of climate change and other changes in natural capital. Those effects will be felt through the income statement. The balance sheet doesn't help you. You know, because what we're talking about here is changes in natural resources, changes in climate, changes in you know, depending on what your business model is, but changes in freshwater availability or forestation levels, whatever it happens to be. Those things affect your business, but those things are not assets controlled by your business. So they're not on your balance sheet. They're not in principle on anybody's balance sheet. You know, so the climate doesn't sit on the balance sheet. But the impact of the climate on your business is captured through your income statement, or potentially is captured through your income statement. Yeah, Stephen. Yeah,
I'm not too sure about that one. You know, we have restructuring liabilities. We're going to restructure and we put a liability on the balance sheet. BP could actually book a liability here for restructuring this business to be green, couldn't it?
No, but you only have a liability if you have a present obligation as a result of a past event. So you know, one of the real challenges, if you take the so the IAS 37, the international standard on provisions,
Ah,
it has an example built into it on, it's an example of as a simplified example, fitting a smoke filter. The law changes in such a way that you have to have a smoke filter in your factory by this time next year. Do you have a liability? The answer is no, because you've done nothing wrong, in the same way that Shell did nothing wrong. Your obligation is to have a filter fitted by this time next year, not to have already had it fitted. And that's the nature of climate targets. You need to be net zero by 2050. So the logical extension of the smoke filter example is you have no liability until the 1st of January 2050, right? It's not terribly helpful.
Yeah, I see that, but maybe that's a question of whether the accounting needs to change.
It does. Because part of the logic of the accounting is you have a realistic alternative. You can exit the business that requires the smoke filter. You can sell that factory to somebody else, or whatever. Or at least you don't have a commitment, and you can meet the commitment the day before the law comes in. Climate change is not like that, right? So the logic of financial accounting doesn't help you. So Dipta, go ahead.
So it seems to me that you do have a liability regardless of what IFRS says, because you can estimate how much it will cost you to fix it and so on. Otherwise, you'll say we don't have an income tax liability. I mean, you could exit the business. I mean, I don't understand.
But do you
regulation creates liabilities, and that's the biggest liability in all this climate change, right? It's not really the cost of transition. It's the cost of the regulation.
Okay. That's an interesting question. So what you're saying is, should you? But even then, the cost of the regulation, aside from whether you can measure reliably or other reasons why you wouldn't create a provision, if the legislation hasn't happened yet, or if you don't know what the financial consequences of the legislation will be, or if the legislation requires you to do something by a future date, it's pretty easy to get away with not recognizing a liability, isn't it?
It's a contingent liability, and the question is, how you assess likelihood. If you're saying that the Paris climate and say European regulation or California regulation is all but certain, then your likelihood goes to well above the threshold for recognition of liability.
Well, I don't know, because the question then is there a past event that makes the
regulation is the past. I mean, I don't think the Paris Accord or the regulation is the past event. I mean, it doesn't have to be something you did necessarily.
Well, it's the legislation that relates to the past event. I think that's I think it's. I think that the financial accounting solution, in a sense, is deeply unsatisfactory here for the reasons you're describing.
Okay.
But I don't think the answer is in the financial statements. I think it's outside. Anyway, it's important. It's a really important one to think about, because I don't think that provisioning as required by financial accounting does the job in this space. Let's move on. So I've described financial accounting and sustainability related financial disclosure as being discrete from financial accounting, but as part of financial reporting, as financially material. A separate question is providing information to those who have a legitimate interest in the corporation, but they're not investors. So if you want to provide information that is consistent with your corporate reporting system that provides information to other stakeholders, how should you think about that? Well, here I think you need to focus on natural capital as analogous to financial capital. So if you think about financial capital, you've got financial capital maintenance, and you've got profit as income on financial capital. Natural capital you can think of as being the same. You've got the resources of nature, which are the capital you're maintaining, and you have the ecosystem services that they provide, and that's the income that they generate. Henry.
Thanks, and feel free to defer this question,
Sure.
But obviously, I guess one thing I'm curious is a lot of the reporting regulation has been coming from a securities perspective, where investors are sort of clearly the stakeholders of interest, whereas a lot of, I think the potential to incorporate broader stakeholders potentially falls under more corporate law. So in the US, I think that tends to the state level. So it potentially come a lot through Delaware law and potentially other state level, and wouldn't really rely on whether a company is public or not. You see this a little bit in the EU with the reporting requirements for both public firms and I think it was like public interest.
You see with the EPA, don't you, in the US?
Sorry. Yes.
You see with EPA disclosure.
Yes. So there's like topic specific regulators. So the EPA, there's certainly like injury reporting at the employee level. But I guess what I'm curious about is your proposal something that you think a securities regulator should do, or you think should come from, is this reporting that you think would or should be mandated by the people who are responsible for corporate law, securities law?
So I'm not making any claims or suggestions about, as it were, who should do the reporting. But if you take you're absolutely right. If you take a European perspective, the EU is in the process of developing standards for double materiality, right? So in sharp contrast to the SEC, where the climate disclosure proposal is investor oriented, the European legislation in principle is how do companies report to investors and to society. So there are different ways of thinking about the institutional structure of legislation, who sets the rules and so on. What I'm trying to do here is set out what are the conceptual bases to think about these different reporting requirements. We've got Sudipta and then Stephen.
So, in most countries, natural resources are owned by the government, not by companies.
Yeah.
The US is an exception.
Right.
So the question is, who should be the reporting entity? Isn't it the one that controls the resources, in which case shouldn't be focusing on government reporting rather than company reporting, except the US that is?
I think government reporting is we spend way too much time thinking about the reporting of public companies and not enough time thinking about government reporting. It's absolutely right, especially in this space. I am focusing just on corporate reporting in this paper, and the issue here is one of, if you take a view that the company should be reporting on its environmental impact insofar as it's relevant to its investors, how should you think about that? And separately, if it should be reporting on environmental impact insofar as it's relevant to society rather than to investors, how should it be thinking about that? So the focus of the paper is corporate. But I agree with you, Stephen.
I don't want to hold you up here, Richard, so I'll be very quick. To Henry's point, a couple of weeks ago, I went to a meeting at the Columbia Law School here. It was a closed meeting by invitation only, so people were speaking their minds. And the main speakers were Leo Strine, who was the former Chancellor of the Delaware Court, and Clayton, who was the immediate past chairman of the SEC. And it was all about the 530-page ESG.
It's long.
It came from Gessler. And they said very frankly that what's happening here is the politicians are putting pressure on the SEC to do this. The reason is they have EDGAR, okay? But if you actually look at the law, this is not going to happen. It's way outside the SEC's jurisdiction.
Well, yeah.
I think a little time ago, the Supreme Court said the CDC, Center for Disease Control, cannot order masks to be worn in the workplace. It's outside their jurisdiction, and this is way outside their jurisdiction. The SEC can only deal with sustainability reporting as it affects the investor.
Yes. I think that's absolutely right. And so that's, in the language I've just been using, sustainability related financial disclosure. So for the SEC, the question unambiguously is, what information do investors need to be able to value stock?
Yes, that's right.
And absolutely not the SEC is an instrument of public policy towards the environment. So there's a very bright line, absolutely.
That's right. Yes,
And I think
the
what I'm trying to do here is
the
unpack
courts
that
in the
line.
US will support that that
Sorry, say again?
line.
So just in the interest of time, we've got 10 minutes left. I'll skip. Actually, I'm going to just go straight to, there's various thoughts that are in the paper. Let me just go straight to this, because in a sense, this is a summary which relates to many of the questions that have been asked, and this is the kind of unpacking that I was describing earlier. So category 1 on this visual is financial statements as we know it, right? So IFRS or US GAAP. Category 2 is the space where the SEC proposal is being made, where the ISSB is operating, where the TCFD is, and so on, which is sustainability related financial disclosure. So 1 plus 2 is financial reporting. In other words, reporting financially material information to providers of finance. So overwhelming, the point of this table in part is to say, look, but overwhelmingly, the focus of sustainability reporting is in box 2, but it's confused with boxes 3 and 4, right? So box 3 is if you want to extend the income statement to report, as it were, bottom line profit that takes into account environmental impact, how do you do it, right? So box 1 is, in fact, that's it, right? So box 1 is IFRS profit, US GAAP profit, net income as currently measured. If you then deduct from that the cost of externalities, you get to sustainable profit. And the way I'm suggesting you should do this is this replacement cost notion. So if you take the measurement of IFRS profit, what you're doing is saying the benchmark is financial capital maintenance. You make a profit if capital goes up. If you take the analogy to natural capital, you'd say, right, negative externalities are the concern here, not positive ones. So if a company has a negative impact on natural capital, then that's a negative externality. Natural capital is not maintained. The notion of sustainable profit here is, what would the profit of the company be if it had a non-negative impact on natural capital? In other words, you're saying, if the activities of the company don't adversely affect climate or whatever else it happens to be, climate's the easiest example, then what would the profit be? And the way to think about that is, what would be the cost to the entity of making good the damage done by its operations? Now, notice this is not a question for investors. This is a question from a broader societal point of view, right? So IFRS profit is the investor number. Sustainable profit is a measure of, well, net, is this company making a positive or negative contribution to society, right? So investor profit net of, think about it as, the cost of paying a carbon tax or the cost of carbon offset or whatever it happens to be. And the notion of replacement cost is, it's hypothetical, right? Clearly, because if the money was actually spent, it would be included in IFRS profit. But it's treating natural capital maintenance as an end in itself. So actually, there's an ecological, environmental motivation behind the calculation of that number. What you're not trying to do is say, what's the value of nature in some abstract sense? What you're saying is, what would be the cost to the business of not having a negative impact on nature? So that's what the externality accounting box is. And you add box 3 and box 1 together, and you get, as it were, a societal bottom line income statement. And then box 4 is the analogy for externality accounting as sustainability reporting. So as sustainability related financial disclosure is to financial accounting, so externality disclosure is to externality accounting. And that's the least interesting box. But so just one more thought, and we've got a couple of questions. This is another way to think about and to capture all this. The question on the left, does the regulator, does the standard setter have a financial materiality lens or not? If so, then you're in the space of the SEC and so on. Next question, do the rules require a single measure of corporate performance? If so, you're into IFRS or US GAAP. If not, you're into sustainability related to financial disclosure. So TCFD, SASB, ISSB, and so on are all in the space of not providing a single financial measure of performance, but providing financially material information to investors. If you go down the bottom half of this algorithm, if there's a societal materiality lens, and if broad disclosure is required, then you get to the EU legislation that's coming and Global Reporting Initiative disclosures. Notice the box that's empty is the externality accounting box, right? So there is no standard setting, no regulatory body which says what would be your bottom line if you had to pay for environmental externalities. So basically down the right-hand side, you've got the landscape of sustainability reporting. You've got on the top box is the existing financial reporting, which increasingly is not providing the information that investors need because of the sustainability transition that's coming. You therefore have this major growth, as it were, in the second box of sustainability related to financial disclosure. That's where all the action is, and it's investor oriented. You also in parallel have the EU building on GRI, in effect, providing double materiality information. It's not clear how it will do that, but that's what it's trying to do. And there is nothing in the box 3 from the previous slide. Okay, so we've got 5 minutes left. So I'm not sure who was first, Jenny? You're on mute.
I think Steve was before me, so go ahead, Steve.
Okay.
I'm sorry to hold the question time here. What is the credit to the debit entry here? What is the credit, or is it not in the double entry system?
Well, so it explicitly would not be. It would not affect the financial accounting at all, right? So it's additional to.
So it's not a double entry system for sustainability reporting.
So what you could do is either simply report in each individual year, or you could start, as it were, to create an off-balance sheet liability and build that up over time. You then may or may not choose to remeasure that according to changes, if you in the same way you treat an asset retirement obligation. But that would be a parallel, as it were, hypothetical set of accounts.
Okay.
For which you need a baseline, you need a benchmark starting point. Jen.
Yeah, I actually have 2 comments. The first one was related to your prior slide about thinking about the externalities in your direct operations, and then also, further up the supply chain. So currently I think there's, scope 1, 2, and 3 carbon emissions reporting, right? So I guess what it would look like is doing something similar to all the different natural resources, right? So scope 1, 2, and 3, and then also attaching a monetary value to that.
Yeah.
Okay, so then my follow-up question is, since we're going to, be moving to, limited assurance with about all these numbers first, and then eventually to reasonable assurance, are the auditors equipped? First of all, are they equipped to, attach numbers to all of these?
Yeah, they're equipping
and then second,
themselves
should they
very quickly because there's a massive market in this for them.
and
I
then
think they will be, but they're not.
You don't think they will be?
I think they're not, but I think they will be.
They will be.
Because there's a straightforward economic incentive for them to be.
And then I guess should the current auditing firms as we know it, I guess, should they be bearing the responsibility of providing reasonable assurance on this expanded set of
and this space is going to evolve massively. So let's just if we just stick with the sustainability related financial disclosures for the moment, just the financially material stuff to keep it unambiguous. There will be audit requirements for the SEC proposal and so on. And for scope 3, we're some way off having the data and the control and the systems and all the rest of it in place. But that will come. I mean, it's relatively straightforward to see that. Whether the Big Four should be the auditor is another question. Now, the more you think about sustainability related financial disclosure being part of financial reporting, and go back to the discussion we just had about provisions, right? That discussion is both a financial reporting discussion and a non-financial reporting discussion, as it were. You kind of probably want the same auditor signing off on both parts, actually. So I think that to the extent you want integration of the financial and the sustainability stuff, which is the direction of travel, I think the market demand is going to be for the big four to take on that responsibility, and they would be very happy to do that, I'm sure.
Thanks, Richard. Interesting thoughts.
Barrett, I'm not sure I answered your earlier question or not.
Yeah, so we don't need to go down that route, but yeah, I think it's very interesting to think about. But because when you talk about what's the cost to kind of remediate or clean up the environmental mess you made, you think about Procter and Gamble and all their plastic packaging. Like, so what are you saying? Are you saying cost to recycle it, like, versus cost to bury it and make sure it doesn't get into the ocean? But that's not the question I'm going to ask right now.
Yeah.
What I'm going to ask right now is you've said that these disclosures are not necessarily for investors, right? They're for kind of society at large, anybody who might be interested in this information. So I think that, Henry's point about, is this going to be required for private firms in addition to public firms is really important in that regard. But I guess my actual question is, when in financial accounting, we talk about information being decision useful. And I guess what I I'm curious to know is, what decisions do you think people are going to be making based on your sustainable profit number?
Well, so bear in mind, this is, so if you include the externality accounting bit, right, this is not investor-oriented disclosure, this is societally oriented disclosure, right? And so the decision maker could be governments tightening regulation. It could be consumers deciding not to buy. It could be employees deciding not to work for that organization, and so on. So I think the consequences of non-financial reporting to stakeholders other than investors are far more difficult to predict than the sort of the more established investor-oriented disclosure. But it's hard. But it's hard to imagine. I mean, I need to stop to allow time for a second presentation. But it's hard to imagine transparency on corporate impact on the environment having no consequences. I think is the way to describe it. Entirely separate issue for investor information. Let me stop there. Thank you.
All right. Thank you, Richard. Thanks for the very interesting and thought-provoking presentation. So now we're going to move on to Henry Friedman. He is going to take the next 45-minute slot. So I'm delighted to present Henry. He'll be presenting a theoretical framework for ESG reporting to investors.
Thank you. Is the screen sharing working? Cool.
Yes.
Awesome. All right. Well, it's a pleasure to be here. Thanks to the organizers. And I just want to say, I also found Richard's talk extremely interesting. It's really neat because I think it, from a purely selfish perspective, it sort of approaches some of the ideas in the paper that I'll be presenting today, but from, like, if there were more than 360 degrees around a circle, it would be more than 180 degrees different. So it's just a completely different way of getting at what I think are pretty similar types of issues or problems. So the paper I'll be presenting today, it's called A Theoretical Framework for ESG Reporting to Investors. It's co-authored with Mirko Heinle, who I believe is on the call, and he's a professor at Wharton, and Irina Luneva, who is a PhD student at Wharton. Okay, so I think building on Richard's talk, I don't think I need to spend that much time on motivation. There's just a lot of recent interest in what are now called ESG issues. If we drop the G, then we might think of this as building on a history of corporate social responsibility, socially responsible investment, potentially impact investment. Those don't all mean exactly the same thing, but in some sense, there's enough alignment that they generally refer to. Well, actually, I don't want to go down that path too much. They may nowadays there's, as Richard alluded to, there's this sort of joint meaning of consideration of externalities and also how a broader consideration of what I think of as how will the changes in the world affect the firm. So there's what are my impacts on various communities from a local to a global perspective, and then also how will changes in the world like global warming affect the firm. Or probably the most top of mind one for me right now is extreme weather events. That seems to be the more near term. If it's not so much that we'll have to turn the thermostat down another 1.5 degrees Celsius, it's that the odds of flooding, droughts, torrential rain, extremely damaging wind seem to be significantly higher. Anyway, that's not accounting, that's climate science, which is not really what I'm here to talk about. Getting back to the accounting, part of the reason we're interested in this is because there's just been a tremendous amount of asset allocation to the ESG space. So you've probably seen variants of this graph. I know I've seen it several times. There's a bit of a hockey stick curve with, I think, something around 16 trillion assets under management as of 2020. I've seen numbers up to around 50 trillion. Also, as Richard alluded to, and as everyone seems to be aware of, there's ongoing regulatory initiatives in the EU, in the US, also throughout the world. Many of these build on the TCFD recommendations, but not exclusively. TCFD, SASB, and here are just some screenshots. For those of us in academia, the last year has seen a tremendous amount of interest on the academic conference circuit. So some of you may be going to the JAR conference or watching it tomorrow and the next day. It is about the economics of sustainability reporting. And I think we'll see what that means in the next couple of days. Of course, there was the CARE conference, RAST, and so on and so forth. So what are we trying to do in this paper? And for those of you who haven't had a look, this is a paper built around a model. So we're not doing data analysis in this paper. There are possibly normative implications, but they're built from an equilibrium analysis of a model. So what we're trying to do is provide at least an initial framework for thinking about one firm's ESG reporting to investors. And the hope is that this might be useful to researchers, policymakers, policy influencers. So I saw, Richard's involved in the accounting for sustainability. There's the ADP. I think this is really a great opportunity for us to try and spread some insights from this paper. So what sort of research questions can we tackle? And I think there's lots of other, we think we're capturing some of the first order aspects of ESG reporting to investors. These are not the only aspects. So the questions may highlight some aspects that we, for parsimony, left out of the model. Okay, so what types of research questions are we interested in? Well, things like, how does ESG information affect prices? And some of this depends on how much investors are interested in the information, what they're interested in. And furthermore, if we think about taking our models predictions to the data and trying to use the data to help better understand what some latent parameters might be, we could think about looking at price responses to when ESG type information comes out, or we can think about effects on the overall cost of capital. Where I think this ties into some of the aspects that Richard was talking about a little bit more in terms of how can we get the firms to do things that are different than what they would otherwise do? How do we get firms to align with the Paris Agreement, with limited global warming? We think that reporting can play a role because it facilitates price-based incentives. One question that's come up is like, so in our model, we're abstracting away from explicit contracting, but I think based on what I've read in this space, that's pretty reasonable given that there are the couple papers I've seen on ESG, explicit inclusion of ESG metrics in executive contracts has basically been that they are just absolutely overwhelmingly swamped by equity-based incentives. So what we're doing is channeling the incentives, the ESG related incentives through stock price in terms of how investors react to that information. And then third, what reporting properties encourage or potentially discourage greenwashing, that is over-reporting ESG performance. Okay. So the organizer asked to touch on reporting design implications. So I think what we get at, and it's a little bit more abstract than, Richard's paper was very much here's something that should be done from a either regulatory or voluntary firms should adopt this perspective. What we're able to help folks think about is what are various regulatory levers. So you could think about a report being designed to convey information about inputs versus outputs, or things that are inside the firm's control versus outside the firm's control, or manager's control. Those are going to be mostly interchangeable, firms and managers, because we're abstracting away from agency issues between firms and managers. And that's going to affect, essentially, some of that may depend on the balance between incentives and valuation. In this version of the paper, we've also got a fair bit of focus on how different actions are emphasized, so how they're aggregated in a report, with the underlying idea that we're coming down to a single number. And then also we can think about how do misreporting costs play in. So one way to think about that is, and I think Jenny mentioned limited versus reasonable assurance. So what sort of level of restriction on something like greenwashing do we want? How is that going to influence how investors use the information that comes out? And then potentially how is that going to feed through and impact on decisions that managers make? And a lot of this depends on the goal of the report. So I think, again, it was really nice to see Richard's talk and the flow chart near the end, thinking about, well, do you need a single, not talking so much about whether you need a single measure or not, but are we interested in providing information to investors primarily? Are we interested in trying to get firms to mitigate the climate crisis? Or are we just trying to provide investors with information that they value? Those are going to have different implications for what the reporting looks like. Okay. It's totally fine if there are not questions, but happy to take questions along the way. I'm going to just next jump right into the model.
Hi, Henry.
Yeah. Hey.
Hi. I read the papers just briefly, and then I have a question before you jump into the model setup, but related to that. And so when I read the paper, I kind of feel like your setup, how do you think about this ESG information and actions or projects will be different from any other kind of a project, for example, long-term R&D projects that are unobservable efforts to the external investors, and then there's a future uncertain outcomes. Is there anything unique about the ESG actions and projects activities that's actually require different information attributes that the firm need to communicate in their public disclosure?
Yeah, so this is a really good question that comes up probably every time we present this paper.
Yeah.
So I think there's two main things that separate the ESG information. One of those is, well, I'll just say what they are, and then I'll say which ones explicitly included in our model. The main thing that people seem to agree on is that the ESG information is what makes it different from other information is typically the notion that there's externalities. We don't have more than one firm, so the way that externalities play into our model is that there's a fraction of investors who care about them. So there's a fraction of investors who care about the ESG performance, as opposed to something that's, a fraction who care about the ESG performance in and of itself. In contrast to cash flow effects, where presumably everyone cares. But I think you bring up a good point. One thing that occurred to me when I was reading the SEC proposal on climate-related disclosures, there are lots of different types of risks that firms face. And I wasn't really sure. I mean, I see to Stephen's point earlier about the closed door meeting, there's clearly a lot of political will from at least a fraction of the population for climate-related disclosures. But you could think of a lot of other sources of risk where you can imagine the SEC saying this is really relevant to investors. They should provide a lot more information. They should get it audited. They should provide it after the reports come out. So
yeah,
and
so,
some of those may fall
related,
under
yeah.
ESG. Sorry, yeah.
Yeah, so that related to that, I find that the Richard's framework is very helpful. It's like, I think the financial reporting and the statements that he talked about is kind of more passively managing the risks firms face, right? Either from regulatory mandates or from their business environments. They just want to navigate those risks. And ESG will be some of the risks probably are more salient now compared to other risks SEC already required in their disclosure mandate, right? The risk factor. But externality will be another layer that whether you want to do even more in addition to compliance and mitigating risk to actually do something good for other firms or other entities in society. And that's probably not a focus of your model right now because there's only one single firm.
Well, so I think the way that filters into the model is that there's a fraction of investors who care about that intrinsically. So,
okay.
Yeah, we don't have a second firm, but it's sort
Yeah.
of straightforward to build that in if you have the ESG performance affects something else that investors have some economic or consumption or personal stake in.
Okay.
And it could be another firm. It could also be like, how many days a year can you go to the park? Can you take vacations? So just to sort of emphasize the point, I don't think the SEC has come out with a 400-page proposal, and I'm taking 100 pages off because maybe they don't need 500 pages for this, on pandemics, right? Pandemic risk is clearly huge. So there's the possibility for tail events. These tail events, at least globally, seem to happen in some region every 5 to 10 years, but we're not seeing extensive disclosure required on pandemic risks. Yeah, sorry, I'm diverging from what's in the paper, but a lot of our motivation is basically, this is something that people seem to be interested in. Can we try to filter this into a model to try and better understand what the economic forces are? And I'll just, the last point I want to make on this is, I agree with the view that ESG reporting is not that different from other potentially non-financial reporting. So the idea of putting dollar values on it is taking a useful next step. But I mean, people have been thinking about customer satisfaction for a long time. People have been thinking about governance for a really long time. So, the expertise on the board in various dimensions has been important for a long time. So that's not like a direct dollar amount, but it is something that potentially it looks a lot like ESG reporting, I will say. But it's a lot of our motivation comes from just the regulatory interest, the societal interest, and the dollar values of capital that seem to be allocated associated with this. Okay. So what do we have? We have what we believe is a simple-ish start. So it's a single period competitive capital market. There's asymmetric information between the firm and investors. And that creates a demand for the investors to learn something from the reports. We're not really worried about liquidity per se. We've got a competitive capital market, but the manager potentially knows more than investors. And the manager is going to maximize stock price minus various costs. And those costs are going to be coming from the actions that the manager takes, as well as the reporting choices that they make. The information is symmetric among investors. Asymmetric information on the ESG side potentially matters. We're abstracting away from that. It's not something that there's certainly been a lot of research into whether ESG information is value relevant, but haven't seen as much on how you can potentially profit from ESG related information. That seems to sort of go against the spirit of ESG related information, although I'm sure there are folks who are using this from an arbitrage perspective. Stock price that goes into the manager's objective function is established via, again, this competitive capital market and trading. So it depends on investors' preferences. It depends on the distribution of investor preferences as well. So for us to get at aggregation effects, or how much do ESG reports weight different things that the firm does, we're going to use two actions, E1 and E2, or efforts. You can think of these just generically as each one of these is a continuous choice that the firm makes. So more or less of something. It could be fuel mix. It could be how much do you try to capture and bury your carbon. It could be how well do you treat employees. Cash flows are going to be some expected cash flows. Setting this to 0 makes things a little bit easier. So you can think of that as set to 0. At least when we started writing the model, we were thinking about the E's as having positive effects on ESG and possibly negative effects on cash flows. So the effect on cash flow is this theta vector times the E vector, and then there's some noise in that. There's some stuff that's outside of the control of the managers. So we're in the process of revising this. So if you have feedback on it also, it's helpful. We're probably going to switch the sign of this back to being positive, but that's neither here nor there. ESG performance is the stochastic variable Y. It depends on the efforts that the manager chooses. And then there's some stuff that's outside of the manager's control. So there's a couple ways to think about this. It could be, this is the ESG effect of processes or actions or fuel blend. And then it could be that epsilon Y is, it's basically just other stuff that's outside of the manager's control. One thing here is that in the main text that was distributed, we assume that the covariance between these error terms is 0. It doesn't make a huge difference. It changes the learning a little bit, but it might make sense for us to think a little bit further about when we relax this covariance, then there's things like something that affects the ESG performance will be correlated with the firm's cash flows. And I think that that seems to be an important aspect of at least the financial materiality side of sustainability reporting. So there's stuff that's going to happen to the firm that's outside of their control that affects cash flows. Okay, so what types of things might we be thinking about? So what are these efforts potentially? So it could be your mix of recycled versus virgin plastic. It could be, if you're a lender, how much do you do general versus specific? And in particular, how much is captured via scope 3 emissions? It could be how much are you spending on carbon offsets? So a lot of these, there's a negative effect on cash flows, a positive effect on ESG outcomes, but you also have things like, are you treating your employees well? Are you treating your customers well? Where you would potentially have positive effects on both cash flows and ESG outcomes. There's a continuum of risk-averse investors. So this is what the market looks like. And getting back to Ayung's question, type 1 investors only value cash flows. And to be fair, much of this builds on a previous paper by Mirko and I in, I think it was a 2016 RASP paper. The type 2 investors are the ones that care about ESG. So they value these externalities. They value them from a warm glow perspective. So they just care about them, but on a per share basis. So this is another thing that I think is what separates the investor perspective from the societal perspective. These investors care about the ESG performance of the companies they own in proportion to their ownership. And that's not the same as like, they don't want to, their utility doesn't depend on, I mean, it may depend on the world staying below or the world abiding by the Paris Agreement, but their utility really depends on the ESG performance of the firm vis-a-vis ownership. So it's this warm glow. This is a pretty common assumption for folks who are modeling stuff in this space. But if any of you are interested in this, I think this is, Mirko and I have another paper that breaks those two out, and we're working on seeing like relative importance of either of those two. You might see this referred to as pure versus impure altruism. So pure altruists basically want the world to be better. Impure altruists care about their association with things that look like they're making the world better. These type 2 investors are, in some sense, impure altruists. And that may be too negative of a label, but they care about what the firm is doing in proportion to their ownership. Their ownership is QI for type 1 and type 2, Q1 and Q2. Everyone's got carry utility. In this version, they're risk averse and cash flow only. I think we're going to relax that in the next version. So 1 minus lambda are the type 1 investors. They've got a pretty standard carry utility. Risk aversion rho. I get some cash flows from however many shares I own times the number of shares plus risk-free asset. And then there's the remaining investors, the remaining Lambda massive investors on a, it's a little bit, there's some typos in here, but it should be Q2 times X plus E of Y given the information they have. And then the ownership and the risk-free asset should be outside of the parentheses, and then it should close. So sorry about that. This means that they're risk neutral in ESG performance. If we just had Y up there, then they would be risk averse with respect to ESG performance in a way that's basically treating the ESG performance as a cash flow equivalent. So there's maybe some scaling. This lends itself to the double materiality reporting that Richard proposed. So what they really care about is like the final bottom line, whereas the cash flow investors care about just what were your profits. Ayun?
Yeah, Henry. First, I really like that you and Mirko kind of putting to a theory economic framework. So it's kind of put us to in a more structured way. I want to go back one slide. So when you think about that, there are one more like E1 and E2, two different efforts. Does your model think about there's a limitation, a constraint in terms of a firm's resources? So like, is the E in total actually the efforts is unlimited or is actually constrained so that there's actually a substitution? That if a manager spend more efforts on E2, somehow they don't have enough time or efforts on E1, or it's actually unbounded that they have unlimited efforts?
So there's quadratic. Let me jump forward a little bit actually. Yeah, so
the cost, okay.
Yeah, so I think that it'll just be easier for me to answer the question in the context of the model. So where the information asymmetry between the firm and investors comes from is that the managers have some privately observed preferences. So these, you could think of these as like bliss actions or what the firm would be doing absent capital market incentives for E1 and E2. So it's Phi 1 and Phi 2, those are the bliss points. The cost of the efforts takes this expression, which basically ends up being E1 minus Phi 1 squared plus E2 minus Phi 2 squared. So they're not unlimited because there's quadratic costs in each, but we have not introduced a like an interaction term such that doing more of E1 either makes E2 more or less costly. So I think you can make arguments that there would be positive or negative spillovers from a cost perspective, depending on what action it is that you're modeling. You know, it's something that I think we could add in. I don't think it would change things too much. You run into a little bit of a different issue. Yeah, never mind. There's potential aspects that come in. Holmstrom and Milgram, 1991, have that sort of trade-off. And for the most part, it doesn't introduce too much. The one interesting thing that you can get is there might be worlds where you want E2 to be 0. So you don't even want a little bit of it because having a little bit causes the cost of E1 to jump. Maybe. Or rather, moving it away from your bliss point is going to cause it to jump. Okay, let's see. So the price is just set by market clearing. So Lambda investors own, Lambda fraction own Q2, 1 minus Lambda on Q1, and there's 1 share per capita. The ESG report, I'm going to call that R. This is where a lot of the action is. So the way we model this is by a quadratic cost for what the numerical value of the report takes. So the first thing is, so we could think about this as the manager is going to get penalized from a cost perspective if the report deviates from this zeta t times E minus nu times epsilon y minus epsilon r. So we've got some weighting of both of the actions. That's both of the efforts. That's the first thing. So, and we could think of this zeta as like as a policy choice, basically. And then there's this new is, are we putting weight on the stuff that's outside of the manager's control, that's relevant to investors, but not up to the manager's actions choice. And then finally, we've got a Diane Streethard type ex ante uncertain reporting incentives. So it's similar in spirit to the Fisher and Verrecchia uncertain reporting incentives, but it operates through the cost function instead of the weight on price. And what this is going to do is basically push the report away from whatever it might be designed to capture. So we can think of these two parts as what is it designed to capture, and then what are the manager's reporting incentives that are going to push it off of that. They're idiosyncratic, and this is basically going to introduce noise in the report. There's a cost parameter out front. It turns out it doesn't do much. So in the next version, I think we're going to introduce a cost parameter over here, which is basically scaling how variable are the manager's reporting incentives. So that makes it harder to learn. And that's what this down here, this delta R, epsilon R is. Okay, so we could, just to use this plot for a moment, we could think of the cash flow investors only. They want to learn about down here, they want to learn about the effects on cash flows. The ESG investors want to learn about the effect on ESG and the effect on cash flows, but the report is capturing the actions or the efforts in a potentially different way. Plus it's capturing the thing that's outside of manager's control. Plus it's capturing the manager's idiosyncratic incentives. Penguo?
Hello, Harry. It seems to me you made an implicit assumption. Type 2 and type 1 investors have the same risk aversion, right? Degree of risk aversion. Is that right?
Yeah, it's explicit, I would say.
Right. Okay. And also why your objective function is maximizing price rather than sales or profit.
For the firm.
Yeah, this one, yeah. So also, I think it's probably make more sense if you maximizing profit or sales number, right? It seems to me you're just maximizing price. Or...
Yeah. So I think there's two reasons for that. One is that if you look at the economic magnitude of incentives for managers of public firms, at least, it does seem like stock-based compensation overwhelmingly dominates, just in terms of dollars, especially if you take into account their portfolio holdings. Second, if the objective was just profits, then going back to the setup, we don't have profits per se, we have cash flows. So if the objective were profits, then we would just say the manager maximizes this thing X, we forget about Y, and we basically go home.
So your X bar is nothing related to manager's efforts, right? X bar is the fix.
Yeah, X bar is just a mean, an ex ante expectation. You could set this to 0, it doesn't change anything. What really matters is what are the, from this perspective, is what are the actions that the manager is taking. I mean, another way to do this would be, again, we're not taking a bonus contracting perspective, but you could think about this as a multi-action contracting problem, where you can pick an objective function for a principle that's some combination of X and Y, some linear combination, typically linear combination of X and Y. And then you could set up the contracting problem. I actually think that, who is it? The two folks at Chicago, Riggs, Cragen, and Bonham have a paper that's also called something like a framework for ESG reporting that comes at it from an agency perspective, and I think does that to some degree. Now, they're not in a linear exponential normal framework. They have different distributional assumptions. But they're really thinking about what is the bonus that you would set. My reading of the practitioner and regulatory literature is that is not where the action is. So I don't think it's an unimportant problem. I think it's potentially quite important, but if we think about, like, as Richard pointed out, whether it's good or bad, a lot of the regulation, at least in the US, and a lot of the focus is coming from securities and public stock, basically.
But I think it is, there's two types of investors may have different, degree of risk aversion. Because this is quite, I think, a reasonable assumption. I'm not sure for some reason, and you assume that the same. Is that just for you are, get a closed form solution, or some other reason?
No, I mean, we'd still have closed form if they had different risk aversion. It would just be more complicated. So, I mean, I think we could introduce it. The problem when solving these models is usually not like, often allowing different variables to have different values is not a huge deal. So like the risk aversions could be different. The different investors could have different weights on cash flows. They clearly have different weights on ESG performance. A lot of the issues come in if, one thing that we can't really introduce, and sorry, this is chewing up really valuable time, is like, what if the type 2 investors can influence the action that the manager takes directly, and their influence depends on how much stock they own. So the problem with that is it introduces higher order terms in their demand function, and then it becomes intractable, because then we have to solve a higher order polynomial. Different risk aversions is not a problem. It's just a question of like, what will that allow us to do? Well, it'll allow us to build onto what we already have, a question of what if you increase one investor's risk aversion and not the other. Another thing that we could do is have different risk aversion for the type 2 investors. They could have one risk aversion in cash flows and another risk aversion in ESG. And remember, risk aversion is just curvature of your utility function in a one period model. So I don't think we have a lot of great empirical, so some of our thoughts are guided by what can we actually take to the data, and what can we use the data to infer. Like our measures of risk aversion, even in a world where we only have investors who care about cash flows, seem not to be that great. So that's part of why it wasn't a direction we went down. But it is something interesting that we could definitely pursue, potentially an extension. So in terms of the objective function for the manager, as Penguo pointed out, the manager is going to maximize price, net of the cost of efforts, net of the cost of the report. So the manager observes their bliss action, their bliss efforts, or the default efforts in some sense. These aren't observed by investors. So investors really want to learn about these because they guide what efforts the manager is choosing. Managers then observe this part in the reporting cost function and choose the report. The report comes out, and then investors trade, and finally we get ESG performance and in some sense consumption. Without reports, the managers choose their bliss action. There's some weighting on that. So there's a full weighting on cash flows. There's a lambda weighting on the effects of the bliss action, of the effort that they take, which in this case is the bliss action. There's a lambda weighting of that on the ESG outcomes. And then there's this risk aversion term that relates to the risk associated with cash flows. Where does that risk come from? Well, it comes from the epsilon X, and it comes from uncertainty in what action the manager is going to take. So that's this sigma phi, multiplied up by the effect of those actions on cash flows. So without reports, this is the price that we'd have. The managers would just do their bliss actions or their default actions. When we introduce reports, and this is probably why we think about this as a framework, it's because it illustrates a few ways that the report affects prices and actions that the manager takes. So first, the price changes due to a change in the expected cash and ESG performance. So before we still had this lambda eta minus theta leading term. We had the phi here, and now we've got an additional term. So there's the sensitivity of the report to the different efforts. There's one divided by the cost of effort. And then there's this side term, the pitchforky Greek letter. And what the pitchfork Greek letter down here is, that's the price sensitivity of the report. So if the report's really sensitive, if the price is really sensitive to the report, then that's going to provide a strong motivation for the manager to pursue actions that increase the magnitude of the report. And that's why we've got this zeta. And if efforts are really costly, that's going to weaken that incentive. Okay. So, and this can all be anticipated by investors. We know that how they can anticipate how managers are going to react to the report based on the information that they have. The second component is the response to the report. So for each of these two additive terms, we've got this R minus E of R. So this is basically what's the surprise in the ESG report. This first term is, I'm learning about the actions. So whenever we see this sigma phi, it's that's the variance in the actions or the efforts. So investors are learning about those. Their learning depends on how sensitive the report is to those efforts. And then the importance of that is basically 100% times cash flows, and then the fraction of type 2 investors times how much they care about the effect on ESG stuff. The other thing that investors are learning about, and really it's only the ESG investors who care about this, but they're learning about that epsilon Y component, that ESG performance that's outside the control of managers, which depends on this new parameter, as well as the variance of that component. And then third, we've got a reduction in the risk aversion, because the report, even though it's an ESG report, it's providing information about the actions that the manager took, and those are relevant for the firm's cash flows. This term in the middle here, we can combine them. What we get is the psi term. So the psi up here is the sensitivity of price to the report. So if we take the derivative of this whole thing on the right side with respect to R, it's just going to pull out this leading coefficient, and that's the psi. So we could think about this as like an ERC, but with respect to the ESG report. Okay, so I'm going to skip ahead a little bit. The real effects are going to flow through managerial efforts, and they depend on price sensitivity which is endogenous, as well as the sensitivity to the report. So what we can think about is, where did design choices pop up? One of the places is in the sensitivity to the reports. What's the manager's equilibrium reporting choice? Well, it's what we saw before in the reporting bias, in the reporting cost function, plus basically a bias term, a fixed bias term that's related to how sensitive the report is, the price is to the report. Okay. If we introduce risk aversion with respect to ESG, we're going to add another term and that affects basically the learning about risk. There's an additional learning about the ESG risk premium term that would pop up. Okay. So the reports do change the expected value of the firm, both through the expected action that the manager takes, as well as through the risk premium. So you can see a path through which ESG reporting affects things like cost of capital, but also the level of both cash flows and ESG performance. And I think from if we want firms to, in some sense, do the right thing, this is the term that we're interested in, this leading term here. It's also relevant for investors, but this term back here in the risk premium is really more of a cost of capital, more of an investor relevance. So in the paper, we talk a little bit, I believe, about how some recent evidence on the secular trend of the level of climate concerns and the value of the green factor might be attributable not just to increased attention for climate concerns, but also maybe reporting has gotten better over time, which I think there's significant evidence that it has.
Hi, Henry. Sorry to interrupt, but you have about 3 minutes left.
Cool. So we developed a number of comparative statics, mostly focusing on the fraction of investors who care about ESG, which is lambda, the sensitivity of ESG to managerial effort, sensitivity of cash flows to managerial effort. One thing that's potentially interesting is thinking about this reporting cost variance. So the more of that variance there is, the more important to investors is this stuff that's actually, sorry, I'm just going to skip this in the interest of time. An interesting, possibly counterintuitive result is that there's more efforts when the price response is higher usually, but that's not necessarily the case if investors really want to learn about the stuff that's outside of the manager's control. So if you really want to learn about the stuff that's outside of the manager's control, then an increase in the price response is going to reduce managerial effort. So if you're really interested in like the ESG effects on the firm per se, then increased reporting on that, I think, could potentially lead to lower efforts. So a lot of the results are developed either in a world where we constrain the efforts down to one dimension. We talk about congruence a bit when we, but when we do that, we set a number of the parameters to 0 to be able to focus on basically, is the ESG report capturing the cash flow impact of actions, the ESG impact of actions, or some value weighted thing. And there are, as you might expect, different implications for cash flow and ESG outcomes, as well as price response in those different cases. Okay, that's about it. Thanks very much for your attention. I was asked to, I'm happy to discuss this further. I think this is a really interesting area. Again, we're revising our paper, so if you have other comments, please feel free to shoot me an email. Your feedback would be greatly appreciated. I think the one job I absolutely had to do for next was to include this on my slide. So the next ADP, May 12th, it's going to be an early start like today. Barrett Wheeler is going to kick it off, followed by Zheqiang Huang with, I believe, another model-based paper. Thanks very much. Oh, and be sure to register on the Accounting Design Project website. What I think both Richard and I learned today was if you don't register, you don't have a calendar event that has the Zoom link on it. So I registered at about LA time 7:30 this morning.
Thank you, Henry, and thank you to Richard as well. There are some comments in the chat for both Henry and Richard, so I want to direct your attention to those if you didn't see it already. Everyone, thanks for joining us this Thursday, and have